Today on the interview with me, Aisha Faridi, I'm joined by one of the world's most respected economic thinkers, a former RBI governor, former IMF chief economist, and a voice that governments listen to, whether they agree with him or not. Raghuram Rajan has warned about global financial risks before the world saw them coming, and he continues to challenge comfortable assumptions on growth, inflation, and power. As the global economy resets and India charts its next phase, I speak to Raghuram Rajan on what lies ahead for the world and for India. Dr. Rajan, great to have you with us today on ET Now.
Thanks for having me.
Thank you so much for your time. Right. Dr. Rajan, given the shrinking fiscal space you've spoken about, how do you think the US Federal Reserve will balance inflation targets with political pressure for rate cuts as we step into the new year?
I think the Fed is increasingly dovish. Whether this is because of political pressure or because it sees that labor markets are particularly weak, perhaps more weak than is the public perception, it's hard to tell. With inflation having been above its target for now close to 5 years, you would think that there would be more of a desire to get inflation under control. Now, to be positive to the Fed, it still has reassured markets that it will get there. And if you look at market indicators like the five-year forward expectation of inflation, it is fairly benign. So at this point, it still has credibility. But how long can you be below your inflation target, be above your inflation target and not get it down is unclear. I mean, again and again, it seems to think that this will be a natural process. It doesn't have to keep interest rates overly tight to get there. It's again at it with the cuts which are meant to keep the economy going. Now, if you look at estimates of growth for next year, it's above potential, at or above potential. So it's not as if the Fed is particularly restrictive. What seems to be its focus is more on the sort of K-shaped nature of the U.S. recovery, that there are people who are hurting, especially in the lower middle class. The affordability crisis is an important issue. And so it's trying to keep their jobs. Though, of course, another answer would be to try bringing down inflation, which hurts the people at the bottom much more. But it's chosen one over the other of its mandates. In the meantime, the U.S. economy is chugging along really strongly with enormous investment in AI-related stuff. And with the upper middle class really buoyant on the backs of enormous stock gains and housing prices remaining stable rather than coming down because of high interest rates and low volumes. So all in all, it looks like things will start picking up again in the U.S. as we go into next year, barring something unforeseen on the political front, which of course can never be discounted.
So there's a greater likelihood, in your view, that the Fed continues to stay dovish?
I think the Fed at this point has done enough to claim that it's bought insurance for the economy. It's probably been more dovish than certainly I would have been under the circumstance. But again, one of the issues it's battling with is very, very gray data because, as you know, the government shutdown prevented data on the labor market coming out. So in that kind of situation, it's preferring to be a little more dovish and hopefully buy insurance for the economy. Of course, the risks are that it starts precipitating excess inflation, but also excess credit growth, and that's a concern.
Right. So how will the realignment of global supply chains due to US tariffs affect the American consumer in the long term versus the intended boost to domestic manufacturing?
Well, let's put those two questions as separate ones. One, does it help the US consumer? No, of course not. Tariffs raise prices. That's what the Democrats are pounding the administration with. There is an affordability crisis, and you're just contributing to it, in part by raising tariffs, but also in part by cutting down seriously on immigration, which reduces the supply of labor and which is going to affect inflation numbers down the line as it slows the potential growth of the economy. So that's one aspect of it, and certainly the one point that the administration will make is, well, by keeping out unskilled immigrants, we have somehow created bigger demand for the labor of low and middle class Americans, low skilled and middle class Americans, and that's potentially going to play out positively in the future. Of course, that we have to wait and see whether that is true. On the flip side, is this going to create more new jobs? Are the tariffs themselves going to create more new jobs? The answer is probably not, because what's coming into the US, back to the US, are not the massive labor-intensive jobs for moderately skilled people of the past, but instead very highly automated, work, which requires not your unskilled or moderately skilled person, but your skilled technician to man the machines. So instead of people doing the work that the machines do, we need people who actually keep the machines running at this point. And that's not going to create a whole lot of jobs for the constituency the administration has in mind. But the economy is doing reasonably well on the back of this massive AI boom, and that I think it has sort of pulled the administration's narrative up rather than some of the tariff actions and the immigration actions it has taken.
Dr. Rajan, you mentioned the AI boom. Does it seem real in terms of its impact on the economy? And how long lasting do you think it is given the scale of capex going into AI?
Well, so there are three parts to this, right? One, is the AI investment being used? And the answer is absolutely yes. Given that much of use is not being charged for, there are plenty of users. A little bit like if you were during the dot-com boom, everybody's willing to buy so long as there's no prices being charged for postage. But as soon as the companies start charging, demand falls off. So yes, so long as it's cheap, everybody is willing to buy the AI. But of course, OpenAI is not making money at these kinds of prices and given the kind of market it's addressing. So one is, yes, there's demand. As some people say, the comparison with the kind of cables that were put down during the global, just before the dot-com telecom bust, is that most of those cables were unlit. There was no data going through them. And 15, 20 years afterwards, we've used them fully. So it took a lot of time to use them. There are no unlit GPUs or graphic processing units right now. Everything's being used because the demand is really scaling up hugely, mostly from consumers rather than from businesses at this point. So one is there is demand at the price that they're charging, which is often very little or nothing. The second is, can the companies make money eventually? And the answer there is, the investments that are huge are going into the hope that the company gets a monopoly in AI. Google gets a monopoly, or OpenAI gets a monopoly, OpenAI and its various partners, or Meta. But in fact, when you look at the progress so far, it's been leapfrogging. Each one leapfrogs the other, but nobody has a permanent sort of better product which is going to capture the whole market. And if that's the case, they're going to be very competitive in trying to get. I mean, I was in India recently, and you see Google ads all over the place. You see ChatGPT starting to advertise. So everybody's trying for that market, which means it will be a competitive market, which means where's the money to sort of pay for all the investment you've made, maybe over a long period of time, but it's going to take time to do that. And the third is consumers have taken to this stuff. I mean, that's the nature of the Google ads in India, telling consumers use Gemini. But there is the third aspect, which is when our business is going to use it more. And now, surveys suggest most businesses are exploring, trying to see where they can use it. But when I deal with a chatbot to try and help me with my customer service in the US, it's a frustrating experience. So I don't know that they've got it yet. They will eventually, but that requires bringing the data to bear, updating the AI based on the data, getting the customer experience much better than where it is. That's going to take time. So my sense is a lot of this investment is being made hoping for profits, hoping for um, you know uh, quick uptake, and I think we will see some reassessment of that over time. You saw when you know Larry Ellison's company Oracle uh, declared not so great earnings. There was a big turn down because they've made a lot of promises on investment in AI infrastructure, and that's not going to take a lot. That's not going to take a little time to pay off.
Right. But the larger concern is whether all this investment could eventually go to waste. Would that be catastrophic then?
It will not go to waste.
Hmm.
The question is, will it make money for the investors? That is something more open to question.
Hmm.
Um, all the GPUs will be used eventually. I mean, we may find that there's some new technology which creates more efficient graphic processing units, and the old technology gets superseded. That may be. But typically, these chips get passed down. So, what was used in the US could be utilized elsewhere, and so on. Some of that may happen. But at this point, I don't think there are. It's a question of unused capacity as much as unprofitable capacity.
I want to also talk about China here, Dr. Rajan, because China's growth has stabilized, but at a much lower rate. Do you believe the weaponization of trade and finance will lead to a permanent fracturing of the global trade order? And is that already happening?
Well, it is happening, uh, but the question is how far, and this is where uh, what seems to be a problem is the attitudes of the two biggest superpowers, the two big superpowers, the U.S. and China. Um, the U.S. is it's unclear what the U.S. wants on the global trade scenario. At one point, it seemed as if it wanted to keep down the rise of China, but the kind of bargaining that has taken place with China sort of holding rare earths in its hands and squeezing the U.S. has seemingly tilted that. And it's not clear what the new scenario is, but almost surely what the US wants is a truce while it builds its alternatives to rare earths. But then, people say that's going to take a long while. It's not going to be done quickly, which then means a more long dated truce as the US tries to keep its economy going. The problem with with the Chinese administration is really that it is doubling down on the old plan of high tech investments and high tech production. And the problem with that is it's overproducing in every sector it enters. And that is a structural problem in China because you have a whole lot of provinces with their local champions competing, and they're holding up their companies and telling them to produce more, but that's creating a overall China problem in overproduction, which then it looks around the world to sell. And of course, while the US has reacted, other countries will react down the line to Chinese overproduction and put up barriers, including India, but also Europe, the UK, and so on. So I think there is a very real concern that China hasn't got a handle on its economy. Its real estate sector is dead in the water, and probably has further price falls to go. Its manufacturing sector is overproducing and has been overproducing because of structural problems. Local governments find production to be a source of tax revenue and want to encourage their champions to overproduce. And as far as the infrastructure goes, they've pretty much built what infrastructure is needed. More infrastructure is now wasteful rather than beneficial, except in some rare places. So their own model is broken. They don't have a new model, and they're doubling down on the old model. Ideally, they would, encourage more domestic consumption. They would, deal with the real estate sector because houses are the biggest sort of asset many households have, and so long as it's plunging, they don't have an incentive to spend. Unlike the U.S. household, which is spending as if things are great, which may well be given what's going on. So, bottom line, I think China needs to rectify its growth model while the US can help by, saying, okay, we're not going to totally undermine your growth. We're okay if you grow, and that creates lower uncertainty about Chinese growth. Right now, I think it's unclear how this goes. Certainly, China has to fix its growth model sooner rather than later for the world's benefit.
Right. But if we isolate China's deep tech rally or deep seek rally, which has been among the best performers this year, do you think that story is under a cloud then?
No, I think some Chinese companies are jewels. Their Chinese innovation, Chinese work ethic. I mean, all those are incredible, and I think it's showing. I mean, China is not. In many areas, China is making advances. We saw the DeepSeek movement, but it's emblematic of deeper technological progress, including, for example, the belief was in chip making machines like the ones that ASML produces, which are very, very high technology. China would be stymied because it wouldn't be able to buy the latest machines, but they able to engineer the old machines to do better by adding on to them. That's a level of technological sophistication which I think is suggestive that China is way up there. And that's true of many fields. And a lesson India should take from China: focus on your universities, on your technological capabilities, improve the quality of your universities, improve the quality of your graduates, and encourage industry to do more R&D, to do more innovation, because that's where the future lies. And so long as we're sort of sitting back and watching the world go by, we'll fall further and further behind. This is an arms race, and we need to enter it sooner rather than later. But I think that China has good companies, has good engineers, and those are showing up in stock prices. It's also focused much more on the applications of AI, unlike the US, which is focused more on the foundational models right now. But China is showing the way in some areas, and I think that's reflected in valuations. But broadly, they need to get their act together on the economic front.
I also want to talk about Japan here because Japan is now shaking global markets as the BOJ begins normalizing rates. What, according to you, are the primary risks to global liquidity that was earlier supported by the yen carry trade?
That's a great question. I mean, look, the proverbial Mrs. Watanabe was investing abroad because yields in Japan were miserable, and the carry trade was borrow in Japan and invest abroad. And in fact, it's been made more lucrative by the depreciation of the yen. Um, uh, People look at the US and say, government pressure on the Fed is telling on interest rates. I think equally important is government pressure in Japan on the Bank of Japan, which has kept the Bank of Japan from raising interest rates, either actual pressure or perceived pressure. And finally, there seems to be some willingness in the Bank of Japan to raise interest rates. But even here, there was skepticism after the last announcement that the Bank of Japan hadn't confidently said it is going to do whatever it takes to bring down inflation. Again, Japan, like the US, has had above normal inflation for a long period of time. And the danger is if those expectations get entrenched, which they could well be, then fighting it requires much higher real interest rates. The big problem for Japan, which is Japan is often a precursor of problems elsewhere, is that it has very high government debt. So high real interest rates needed to pull down inflation will actually make the debt burden even higher because the debt service will start increasing over time. And so the Bank of Japan was trying to have it both ways, keep rates low, but also hope inflation goes away. Now that inflation is more entrenched, it will have to raise interest rates. And as interest rates move into very positive real territory, the government has a problem financing its huge stock of debt. So, jury is still out. Japan would benefit from Mrs. Watanabe bringing her money back and financing Japan's debt. But that will also imply accepting a higher yen, which is going to hurt corporations somewhat. But broadly in this world with the global supply chains, exchange rates have less effect on production than we think.
Right. Dr. Rajan, I want to talk about India now because you warned that India could take decades to catch up with US and China. Tell me what structural reforms in those countries could either accelerate or delay India's catch-up timeline?
Oh, yeah, look, I think most estimates of catch up require nothing to go wrong in India. And our pace of GDP growth increases by 1% or 2, and that we do all the right things while everyone else stands still. And what you just indicated is they're not standing still. They are trying to improve the lot of their people. In the US, one of the big issues has been the amount of regulation that has come in over the years and is frustrating any kind of investment. And that, you're seeing in, for example, these Taiwanese chip factories that are being set up in the US. Again and again, you hear the complaint, oh, so much additional regulation here than in Taiwan, so that's why this is taking time. And what you have is a government in the United States that is very willing to tear up regulations. In fact, maybe overly willing to tear up regulations wherever it sees it, and is not going to do anything about the green transition, is not going to raise costs for industry, which may, be necessary for the longer run well-being of the planet. But that's what it's sort of taken up. And I think, in some industries it's helpful. In some industries it may actually be problematic. But that's to some extent, the Democrats also are seeing that maybe they should be on the side of the angels and not keep espousing additional regulations that slow down growth, because after all, slower growth means fewer jobs, and they want jobs for the people. So that's something that the US is turning to, which may in the longer run be very, very beneficial for the United States. Um, in China, I think at some point they'll wake up to the fact that their model doesn't work anymore. It used to work, but it requires a fair amount of thought, which is happening, to see why it doesn't work anymore, and they need fixes. Of course, being a more authoritarian economy, it needs people at the top to change their minds, and that's harder than people broadly who see the consequences of these policies. But if China can fix its growth model and focus much more on the innovation, which is huge and plentiful in China, it could also reaccelerate, find new ways of growth. So I think the jury is still out in both countries. Both are looking inwards. And I think, India, from the recent reforms, is also looking inwards and trying to figure out how to up its rate of growth. Hopefully they play out, but it is something that's work in progress.
Right. Because you suggested that India could turn the US administration's reciprocal tariffs into a strategic opportunity by lowering its own tariffs. How can India ensure this doesn't lead to a flood of cheap Chinese goods rerouted through other markets?
Well, I think, as I said earlier, the world is now getting more apprehensive about Chinese goods coming in, and we have to be clever about it. I mean, one way of keeping out overly cheap goods is by letting our currency depreciate. Of course, there's only so much you can do that without inflation becoming a concern within the country, and without the middle class, which has lots of payments to be made in dollars for kids who are studying abroad, etc., rising up in arms and saying, "Why have you let the rupee cheapen so much?" And in India, it's become a political sort of fetish that the rupee cheapening indicates something wrong. That if the rupee sort of dollar exchange rate goes up, you must be doing something terrible. That's not necessarily true. And so many politicians have worried about the rupee dollar exchange rate going above their age. At this point, I think it's above all politicians' age. So I think we're beyond that controversy. But I think if you look at the real effective exchange rate of the rupee, it's just below what its long-term average over the last decade or so has been. So it's not overly depreciated at this point. I wouldn't worry too much, and I would let it find its level. Perhaps if a deal gets done on the tariffs, it will strengthen again. Of course, the rupee is affected not just by trade, but by investment. And if we can make India a better place to invest, if we can enhance prospects of growth, all those things would help the rupee recover more strongly. But again, I would say the rupee is one way we can actually make our exports more competitive. I would also want, I think I've said this in other fora, our businesses to get more ambitious. Too often they're happy sort of playing in the Indian market and trying to keep out foreign companies from competing with them domestically. Fortunately, I think the government is now opening up to more foreign companies into the Indian market so that our companies first get more competitive domestically, but then also can start looking abroad for markets. You can't be saying every time, "Oh, the domestic market is not working that well," but then look outside. Try and invest. I mean, you can't claim investment is weak because the domestic market is weak. No, the domestic market is not your only market. Look abroad and try and invest for the broader world. And this applies as much to services as it applies to industry, to manufacturing.
But with 50% tariffs hitting labor intensive sectors like textiles and gems and jewelry, how should India support small exporters without resorting to unsustainable subsidies?
Well, it should do the deal on tariffs. I understand a deal was available in July for a variety of reasons, which one can speculate on. It went off the table. This is important because, as you correctly point out, our exports actually to the US are not doing badly according to the November numbers. In areas like, cell phones, engineering goods, etc., it's pharmaceuticals, areas that are coming below the tariff, sort of under the tariff wall, so to speak, because those goods aren't tariffed as much. They're doing fine. They're doing fine. It's the areas that are tariffed, like textiles, which are suffering hugely. Tirupur is in deep, deeply worse off. And that there's only so much you can divert some of those exports to other countries because longer run, your relationships in the US suffer. And if you don't have the direct relationship with a Bloomingdale's or with a Macy's, they'll go to Vietnam the next time once they've built those relationships. So I think the longer these tariffs stay higher, the harder recovery is going to be. And of course, some of those companies are going to close down, never to open again. Some of them are going to lay off workers. Workers won't come back because they'll go elsewhere. This is something which needs urgent action. And it's not just subsidies. Where are these where are they going to export to? You need to deal with the tariffs sooner rather than later. And I think this is where we need to, push this hard. I presume that's what's going on, but we need to push as hard for a deal. India has the highest tariffs in the world at this point from imposed by the U.S. And for two countries that claim to be great friends, even in the latest national security reading by the U.S., why are the tariffs so high? And it's not that India has stood still on some of the issues that bug the U.S., such as the nuclear, liability issue, which India just passed a bill on. So I would say we need to push really hard, use all our friends in the U.S. to push for India and get this tariff deal done.
Do you also think part of the delay in reaching a tariff deal is driven by personality-based diplomatic friction rather than pure economic data?
I think everything boils down to personality nowadays, but I think personalities should work to get over it, and I would say there's no point sitting on a high horse. I think longer run economic growth will be our source of independence, and from all pressures. And we need that economic growth, including to build our own defense to much higher levels of quality and responsiveness than today. And I think that therefore do what it takes to get that economic growth.
Right. You've also argued that export-led manufacturing model has largely passed India by. Can a services-led growth strategy realistically generate enough low-skilled jobs for India's massive youth population, according to you?
Absolutely. But let me start by saying I'm not against manufacturing, and I think there are many spots where we could still do a lot in manufacturing. And some of the southern states like Tamil Nadu are showing the way by creating an environment hospitable to manufacturing entities coming in. The improvement in our logistics, which the central government has focused a lot on, is huge, and that also helps. And better trained workers are going to be attractive to any entity setting up. Tamil women seem to be the target for a number of Taiwanese and Korean manufacturers coming into Tamil Nadu because they're disciplined workers and well educated and so on. So I think other states in the south are obviously also trying to replicate. The west is doing that. Even the north, Uttar Pradesh is making a bid for industry and so on. What is good is if India remains unified to labor, so that migrants, when there's a shortage in the south, migrants come and enter there. Uh, but you can already see, and this we wrote the book Breaking the Mold before the tariffs imposed by the U.S., but we were even then skeptical about manufacturing because of the rise of protectionism and the fact that China was not going to go away and had huge sort of manufacturing capacity. And you're seeing that again and again. Manufacturing is hard. I'm not saying it's impossible, but having another China come in is the world is not ready for that, and that's why we said we need another path for growth. Now, services, high-end services, doing very well. Of course, AI is an issue, and we have to sort of ride on AI rather than let it displace too many jobs. And if we're good, and certainly AI companies are making a pitch for Indian workers, Indian demand. If we can embrace AI, we can be a continuing force in services. I saw examples of Indian chip design using AI. That's great. Um, but I think for the jobs en masse, it's not going to be in the high skilled services. It's going to be in moderate skilled services, in plumbers, many more well educated, capable plumbers, in many more construction workers, bricklayers, in low level medical practitioners who can use AI to improve the quality of their advice, but know enough to to fix a good bandage on a festering wound and so on. We need so much sort of medical capability that we don't have right now. So I think that urbanizing India, and every small village is really a town by global standards because of our population. The mass demand for services, especially moderate quality services from a growing India, will be huge. And servicing that will be a source of our growth. And that means that we need to focus much more on creating moderate skills. When I see some of the plans that states have for growth, it's always we need more engineers. Yes, you need more chip engineers. You need more R&D. We talked about that in the beginning of the program. But we need many, many more sort of moderately skilled people because that's where the jobs are. And that means both skilling in schools, but also reorienting our skilling institutions, the ITIs, but also new ones. There are states that have done a good job. Orissa's skilling program has been very good. And we can sort of share these best practices and improve. But I think jobs are a problem if everybody's trying for the IAS, in which, well, there are a few hundred jobs, or if everybody's wants a cushy government job. There are not enough government jobs. That's not going to happen. But we need to create many more private sector jobs, and that means not just the big companies, formal jobs, but also self-employment in areas like the urban services that we need so much of.
15 to 30 years for India to reach the economic scale of the US or China. What is the single most critical structural reform that could meaningfully shorten that timeline, according to you?
First, just do the math. I mean, this is not a deep scientific estimate. It's just looking at their per capita GDP and asking how long it would take to reach that. If you do the math, you will arrive at similar numbers. That to get to Viksit Bharat, whatever that means, because there's a wide range of meanings applied to what Viksit Bharat means. But if Viksit Bharat means maybe China is a middle income country, maybe 50% more income than China today per capita, it requires pretty huge growth rates, probably a couple of percentage points than where we are today. And to get that, I think absolutely focus on your human capital at every stage. That is, I mean, this is what Amartya Sen has been saying for a long time. It makes a lot of sense. Right from, deal with the problem of malnutrition. Your malnutrition kids are going to be your labor force in your Viksit Bharat. Imagine people with stunted brains having to deal with a first world economy. That's what you're setting them up for. It's unconscionable first as a country to have kids with that level of malnutrition, but it's also throws a lot of sand in your dreams. So that's something to fix. It's not. It's a hard problem. We've tried, but we need to do more. We have the resources to do that. It's now the kind of programs to see whether they're effective. Better, primary schools, secondary schools to train our kids up. More vocational training in higher education, but then improve the quality of your universities also. We have a huge number of graduates with degrees that aren't worth the paper they're written on. And they go and spend 3 4 years and then spend another 10 years taking all these exams because they want white collar jobs and end up nowhere at the end of it. What we need to do is make the alignment between skills and jobs much more effective. And that means taking a very, very hard look at the whole process. And finally, we need really high quality, top level universities. We had better universities than China, I would argue, at the beginning of this century. Now China has many more top quality universities than we have. Something went wrong as we didn't keep up. Of course, China had more resources because of its growth, but now we need to invest in our top universities because they're going to be the ones doing the research and development, which is needed for industry, but it's also going to be the place where they train the teachers.
But despite the China plus one narrative, companies often choose a Vietnam or Mexico. What is the key missing piece in India's business environment that limits our ability to fully capture this shift?
Well, it's at every stage, but I think we're working on some of it. Logistics, as I said, has improved tremendously in India. The quality of infrastructure is much better. But if you want FDI, you also want quality of life. And this is where, having a gas chamber that Delhi has become as your capital city is not good advertisement. Of course, other cities are much more livable at this point, but it is something to pay attention to. Bangalore, everybody complains about the traffic. So quality of life is another issue. Business certainty is important. I just saw an academic who told me about this paper they were working on, which suggested that the Vodafone retrospective taxation did have a tremendous negative effect on FDI. Now, I haven't seen the paper. I don't know the quality of the analysis, but I wouldn't be surprised that the constant sort of shifting of our regulations based on either the needs of the bureaucracy for safety and protection or needs of business for protection against foreign entrants keeps our business environment very uncertain. I mean, nowadays, where is the tariff going to go up? Is it going to be on my inputs? We need a stable tariff regime at moderate, very moderate tariffs rather than at high tariffs if we are going to be part of a global supply chain. So these are the things we need to work on. Of course, our labor force needs to. We keep saying 1.4 billion Indians. That's great, but how many are trained to do the kinds of jobs that are coming in, and how many are willing? You need both the skills as well as the willingness to take up those kinds of jobs. We need more effort here, but things in India change, and they are changing in the right direction. They often take more time than you would wish. Um, the uh, tough part is the world is moving ahead. We don't have the luxury of a lot of time, so we need to move also.
But with political pressure on the US Fed to cut rates, how should the RBI balance maintaining the India US rate differential to support the rupee while still managing domestic growth?
Well, I will say this again. I don't think rupee depreciation is that much of a problem at the low rates of inflation we have now. Of course, inflation will go up. This is unusual that we are at the bottom of the band that the RBI set out to do. I think inflation targeting that the RBI set out, has been quite successful so far and has brought down inflation to a level we never really experienced before. And that's been good. But now it's time to sort of harvest some of those benefits, which means that we can be a little more flexible on the exchange rate and allow the exchange rate to find a level consistent with the ambitions of our industry. Now, if our industry doesn't want to go outside, then it's tougher. But I think the government has to tell industry, okay, we're willing to do what it takes, but you better show some gumption of your own. And I say again and again, what we need is industry to be more ambitious and to be government to be more supportive of that.
Should the RBI strictly adhere to its 4% inflation target, or is there room to redefine price stability in an era of repeated global supply shocks?
I keep saying, what ain't broke, don't fix it. We've successfully targeted inflation. When I started, um, nearly 10 years ago, actually over 10 years ago, 12 years ago, people didn't believe we would have a reasonable inflation targeting regime. And so we had to work through a glide path towards that. And then we've stuck. And this is one of the successful institutions we have built. Why break it at this point when it's working really well? And industry will come up again and again and say, "Oh, interest rates are too high." There's never been a point where industry has been satisfied with interest rates. The issue is not interest rates. The issue is inflation, which hurts our people tremendously. And it's important to keep inflation contained. And the issue is everything else that goes into creating a better business environment. Inflation has been taken out of the equation. And now it's time to take the other stuff out of the equation, whether it's policy uncertainty or whether it's the quality of the labor force. These are outside the RBI's remit.
If you were still at the RBI today, would you do anything differently?
Well, I don't want to serve as either a critic or an endorsement of current RBI policies. I would say where we are is pretty good.
Okay, Dr. Rajan. Thanks for your time. Thank you really for speaking with us today. It was insightful.
Thank you. Same to you.
Thanks.
And thanks for doing this.